All right, let's move on to Ghana. Ghana's unadjusted gross domestic product slowed to 6.7% in the first quarter of 2013 from 10.3% a year ago, while the rebased consumer price inflation is now at 11.1% year on year from 10.9% in April, and the index was calculated for the first time using a rebased basket with fresh items to reflect the current consumer priorities. I'm now joined by Samson Akligo, Head of Research at DataBank, to give us his thoughts on this development. Thank you so much, Samson. I guess the first thing that, of course, will strike most people is that lower GDP number, 6.7% for Q1. How worried are you about this trend?
Oh, yeah, sure. I think that the GDP numbers are quite worrisome, but we actually expect that to happen because much of the growth slowdown was due to the energy supply disruptions, increases in operational costs in the real sector, as well as a high cost of credit and then the fuel price increases in the year. So that combined with lower export prices is the main cause of the slower growth.
But what's the outlook? I mean, if we look at the numbers for the inflation, 11.1%, that suggests to me that tightening may be here to stay. And so, of course, like you mentioned, the pressure we're seeing in terms of credit growth will remain for the foreseeable future. And so what could that mean for the outlook for the Ghana economy?
No, I think that when you bring the inflation, in fact, really the 11.1% inflation based on the new or the rebased basket is quite a surprise to the market. I think that the difference between the old inflation rate, inflation basket, which turned an inflation rate of 10.9%, compared to 11.1% is quite marginal and clearly reflects the fact that the old basket was actually capturing price dynamic in the country as much. But again, the combined effect of the inflation and the GDP figure clearly shows that we have to focus, or the country has to focus its attention again on trying to develop a policy mix that is a bit not tilted towards the macroeconomic figures, but we also pay some attention to economic growth, which is very important to support the growing middle class demand for jobs.
Right, absolutely. But staying with that inflation number, 11.1%, so firmly above 10%, it's of course based on a rebased CPI basket. What's your outlook for inflation, all things considered?
Yeah, until, in fact, in August, more so in August, we expect that the harvest season would actually facilitate a lower food inflation, which, looking at the dynamics in the inflation, the new inflation basket, should keep inflation relatively stable. So we have seen a lot of the pass-through effects of a combined food and non-food inflation filter through the basket, and when the domestic harvest season sets in, we are likely to see the food inflation moderating. But the challenge remains that to the extent that the currency depreciates and the operating cost of companies increase, we are likely to see non-food inflation still on the uptick.
Right. In Nigeria, I think a lot of people say that the monetary policy is geared towards more of an naira of currency stability as opposed to inflation, because inflation in Nigeria seems to be fairly under control these days. But of course, there are concerns around the outlook for the naira. And would you say that the monetary authorities in Ghana are thinking the same way? The stability of the cedi is perhaps more important than the issues that you've raised in terms of spurring economic growth?
Yeah, certainly. You know that even in Ghana, the central bank has announced an explicit inflation target regime, and clearly one of the preoccupations of the new central bank governor is that he stated publicly that inflation targeting would continue. I think that what we are seeing now is that the currency really has actually become center stage of monetary policy, but because inflation too is moving in the same direction, it has provided room for the central bank to try to really stick to its inflation inflation-focused policy, whilst at the same time have room to also work on the currency by hiking interest rates to support portfolio investment. I think that for now it is difficult to decouple the two, and my thinking is that we are likely to see monetary policy still focusing on the exchange rate and to a large extent inflation, but fiscal policy must work in a way to really make sure that we don't dampen the real sector growth maybe excessively.